Hey folks, Honey Badger here, and today we're going to go over full-time RVing. I'm going to go over how to make your purchase. I'm going to go over warranties, extended warranties, and financing options. Now, if you have not visited this channel before, I have 11 years of RV sales, finance experience. I've worked on them, I've cleaned them, I've washed them, I've done everything you can possibly think of, including owning one. So let's just get the show on the road. All right, let's go over RV loans. RV full-time loans. There's only two, and that is two RV banks that do full-time loans. Alliant Credit Union and Essex Credit. You know what the good news and bad news is? Dealers have nothing to do with those two banks. You have to actually physically apply for those loans on your own. They can't simply do it for you. You must do it. They work with the customer directly. So let's talk about credit unions and banks, both dealer and private party. Dealer, if you decide to go to a dealer or you decide to go to a dealer and use your own financing, you still have to have a home address. If they find out you're selling your home or you've sold your home, automatic decline, because banks and credit unions do not finance live-in motorhomes, fifth wheels, travel trailers, toy haulers. It just doesn't work that way. So my best advice to you, buy it a year in advance, 6 months in advance of when you're going to pull the trigger on selling your home. Now let's talk about home equity lines of credit. Hey, no, I'm not going to sell my home, but I'm going to go full time and rent my house out. Great, fabulous, wonderful, amazing. Bad idea for the home equity line to pay for the RV though. Let me tell you, even though the interest rate is attractive, you are taking a depreciating asset that makes no money and putting it into your home. That's not necessarily a smart thing to do. So later on in this video, I'm going to show you how to take that home equity line, buy the RV, and then turn it into income. Because the number one thing that you're going to run into as a full-timer is an income problem, a cash flow problem. Yes, I have this great idea of I'm working online, working remote. But what happens when that comes to an end? Are you just going to quit? Or would you like to be able to have the choice to do what you want? That's what this video and the rest of this video is going to cover as far as RV loans. Now, my recommendation, make sure that you put between 20 and 25 and 30% cash down on any deal you make, whether it's used or it's new. And I'm going to go into the math of that once we get to the whiteboard. I'm super excited for you folks. Full timing is so much fun. I've done it in my lifetime. It is an amazing trip, an amazing adventure. So let's get to the next segment. All right, what interest rates can we expect from an RV loan? Well, if you're going to go do it, like I said, do it a year, 6 months in advance, you got great credit. You have not just a score, you have great credit. And on top of that, you've got 20, 30% cash down. Expect rates in the 3s and 4s. So anywhere between, let's say, 3.99 and 4.99. You can do a 15-year loan all the way up to a 20-year loan. And the rate doesn't change. It actually stays right within that volume. Any dealership that is mentioning the word 7.99, that's a gimmick they've been told to tell you because they don't know. Most salespeople don't know how to be transparent. They have no clue how. They don't know how it works. I do. I've been doing it for 11 years. And I tell people everything outright because, well, it helps you make more deals. So 3.99 to 4.99 are the expected rates. Now, if you have less than perfect credit, but you don't have a BK, you don't have a repo, you have what we call fair credit, expect rates around the 5 to 9% range. And then if you have way less than perfect credit, expect rates as low as 9.95 and as high as 29.99. I cover that in that series of videos. Again, that's right there. All right, I'm super excited about this today because I have not gone over warranty in a very long time. So let's go into the manufacturer warranty. Let's start with this. Unless it says inside of the actual warranty packet Very few RV manufacturers cover full-time RVers under the warranty. A lot of times, manufacturers will state that if you live in the unit, your warranty is void. Now, the ones that do allow for full-time RVers, it's a 1-year manufacturer warranty. You can, by the way, here's a secret nobody knows. Forest River and a lot of the other manufacturers offer a second year that you can pay for. You have to let the dealership know, I want to pay for the second year, and they can go ahead and process that paperwork with that manufacturer. Now, the structural warranty of the coach is separate from the actual manufacturer warranty. So the structural warranty on every RV is 3 years. That's your sidewalls, your rear cap, your front cap, your floors. And then your roof will have roughly between 10 and 20-year warranty, parts only. They do not cover labor. So if there's a problem structurally with the roof, they'll get it replaced, but they're only going to replace the materials. They're not going to pay for the labor. You would have to pay for the labor separately. Now, on a side note, extended warranties. Extended warranties in the compliance section of the finance manager is called a service contract. It is a reassurance program. That means that the dealer pays X amount into a fund and that all the claims get paid out of that fund. So, do I recommend an extended warranty? Yes, I do, as long as it has mobile service included. And as long as it includes a full timer's clause. And number 3, as long as it is an exclusionary plan. Exclusionary tells you everything that is excluded from the plan, meaning most of your stuff like your appliances, your electrical, your plumbing are all covered. Things that are excluded are generally your batteries, your light bulbs, your wearable items like brake pads or awning fabric, so on and so forth. All right, folks, we're going to go to the whiteboard. So I'm going to give you the pros to financing versus cash. As you can tell, I have a lot more under financing than I do cash. So financing, you're going to get a better price than if you pay cash. Now, that's the complete opposite of what you were raised to be told, but let me tell you why. It's called profit. So this equals no bank profit. This will equal about 4% of the amount financed. So if you have a $100,000 loan, the dealership's going to get 4% up front. That's $4,000 as a thank you. Hey, thank you for giving me the loan. While if you pay cash, that profit's gone. Who gets the better price? The guy that's financing or the guy that's paying cash? Common sense, right? All right. The second thing is you get the title paying cash. And of course, there's no payments. Some people love no payments. That's probably the only reason to pay cash. Now, when you're financing, I'm going to show you the word cash flow because financing can create cash flow. And then your credit is alive. I know I can't spell today. I'm left-handed. Forgive me. You still have some low interest rates. You get to keep most of your cash, and it opens up your options. So let me combine the next little bit with how we open your options and create cash flow, because the number one reason why a full-timer stops full-timing is money. So let's open up your options a little bit here, okay? Now, the budget is $50,000 cash. That's something I got a lot of when I was selling them. When I wasn't in finance, and even 4 or 5 years ago, 50 grand bought you a lot of motorhome. It might have been an 8 or 7 or 8 year old unit, but it bought you a lot of motorhome. Nowadays, it buys you a really, really, really old one. But let me show you and open up your eyes to something real quick. Let's say that you have good credit, okay? And you're going to buy a $100,000 unit. This is tax, title, and license. Forgive my chicken scratch. So we gotta add about 10 grand. That's average in the United States. So $110,000 is what you're really buying the unit for. If you put 20 grand down, you're gonna finance $90,000. Now, if you take a 15-year loan at 3.99%, you are at $665 a month. Correct me in the comment section if I am incorrect on my math, please. I'm doing that kind of off the top of my head. Which means if I'm roughly correct, you're gonna pay about $1,100 in interest a year. Again, forgive me, please. That's how it should break down. Let me know if I'm right on that, okay? All right, now, 5 years from now, you folks told me, hey, we're done. We don't want to sell it on our own, okay? And so we bought it from you for $65,000. All right. Now forget all that. Forget all the other stuff. So at this point, let's just use the 110 number. 110. So off the top of my head, that's $45,000. Plus the $1,100 in interest a year you paid, that's $5,500. Ooh. That means that you spent over 5 years, including your down payment and interest, $50,500. Let me know when you're done being shocked. So the guy who wanted to spend really $45,000 after tax and before tax and license would have spent the same amount of money buying a $110,000 unit. Now I bet you nobody ever went over this math with you because we were taught, even I was taught when I was a kid. I'm an 80s baby, so I was always taught by my parents, you pay cash, you pay cash, you pay cash. If you can't afford to pay in cash, don't buy it at all. That's what I was taught. And then I got into this business and went, holy crap. So, all right, with the rates still low, the rates going up in March, I've decided I'm going to show you, if you're doing this, how to make this happen, okay? So it's very, very attractive to do a home equity loan because the interest rates are really low, and especially a lot of people have some tremendous equity in their homes, okay? So let's dive into it. Let's use the $110,000 that I originally was using in the last segment. Now let's say you take out after closing costs that exact amount of money. I'm going to recommend, if you don't have the down payment already, stick 20 grand towards the down, just like I showed you, and then take $90,000 of equity left. I'm going to show you how to create cash flow. There's two ways to do this. Number one is you can stick the $90,000 into a mutual fund. The mutual fund should give you roughly about $1,800 after taxes per quarter. Whoa, I put half. Good Lord, I must be excited for this football game. So you're gonna get that 4 times a year. That's roughly about, let's just round up, that's roughly 8 grand, okay? The problem with that is that this will fluctuate in value, right? And it would you have to pay taxes on the mutual fund. But 8 grand a year is pretty bloody good money, okay? Now, that is based on your basic mutual funds, okay? Here's what I would do instead. The second option is right now, the number one piece of inventory in the United States is called a duplex. So you can do, this can be 10% down to a 5% loan. So now you got the duplex. Let's say the mortgage is $4,200. All right. So the duplex Average rent on a duplex right now is $2,500 a piece. That pays your mortgage and gives you plus $800. And then you can rent out your own home for $3,600. And that'll give you another $800. Now you have a cash flow. So instead of throwing all of your equity line and only getting $800 every single month, you now increased your cash flow to $1,600. You know what the cool part about this? This is called passive income. Passive income, if you do it right, is tax free. Now you're putting more money into the duplex. Somebody else is paying the equity down. Now you have two appreciating assets. When you do that, now after 2 years, you guys are full-time. You guys said, man, this is bitching. I want to do it some more. You start taking equity lines again out of both homes, and you buy another piece of property, then another piece of property, then another piece of property. And you keep on going and going until you're retired, or until your income from the real estate exceeds your current retirement. And guess all you did? You just took money from your home and threw it into an appreciating asset. You didn't take this money that was available to you and throw it into something that's a toy. The number one reason why full-timers quit is because of cash flow. Number one reason. And that's a big margin. If you actually look at the statistics, over half the people that quit are quitting because of money. Campsites are getting more expensive. Repairs get more expensive. Things go up. But your retirement doesn't. Your income doesn't. So this is just a way for you to keep it going. I'm not telling you what you should do. I'm giving you advice. I'm not a finance advisor, but I'm giving you a way to take this home equity loan and make money for you rather than you just throwing it into a toy. All right, now I'm going to go with private party sale real quick, okay? Because I occasionally get 1 or 2 people that ask me questions about it. So private party, where would I go to get financing? The first place I would go if I have good credit is I go my local credit union. If they don't approve me for anything decent, then I would use a company called Southeast Financial because they're fast. Their rates and their terms are stinky, but they're fast. And right now in this day and age, speed is of essence with private party, okay? Private party, what I would do is I would pay cash if I had it, and then go refinance it or take a title loan out with my credit union. Okay, now that I bored you half to death with everything that I talked about, let me give you the last piece of advice I have for you. Have fun with this process. Don't make it too complicated. I gave you the hardest part, which is all the research. Now it's time for you to go do your homework and go find a unit that works for you and your family. Instead of my usual thing, I'm just gonna keep it short and say, may the force be with you. Always.